Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, so what we'll be walking through today is a U.S. market analysis for Tuesday, March 24th, 2026.
This video presents a direct informational narration of the source document.
We have a lot to get through. We'll start with the big picture, the macro overview and sector performance. Then we'll do a deep dive into the Middle East. After that, it's all about AI compute infrastructure and the major player, TSMC. Then we'll pivot to a gold analysis and wrap it all up with some key technology headlines.
And just a quick but important notice before we jump in. This document is for informational purposes only and does not constitute investment advice. Okay, let's get into it.
So let's start with the macro view. The big story right now is instability, that feeling of uncertainty. And it seems like we're facing a real repricing of risk across the board.
So how did that actually play out in the markets? Well, U.S. equities finished lower, and it was the big names like Google and Microsoft leading that slide. Meanwhile, U.S. Treasury yields shot up, and the U.S. dollar index got a bit stronger, up 0.5%. Gold held pretty firm, closing at $24.24 an ounce. But the big mover was WTI crude oil, which jumped 4.8%. And even Bitcoin futures felt the pressure, dipping 1.8%.
You can really see that split here, this dispersion between sectors. The lagging groups, things like airlines, software, and semis. But then you look at the relative gainers, and it's a completely different story. We're talking energy, industrial metals, and chemicals. It's a pretty clear shift away from growth and towards tangible assets.
And if you look a little deeper into the market logic, a few things become clear. First, that fear of stagflation is definitely creeping back in, especially when you see unit labor costs at 4.4%. We're also starting to see some liquidity warnings pop up, like the redemption pressure at Apollo. But on the flip side, M&A activity is still looking pretty healthy.
So what does all this mean? The whole narrative is shifting. We're moving away from that comfortable, soft landing idea and more towards a real concern about stagflation. And in an environment like that, efficiency becomes everything. That's why AI automation isn't just a buzzword anymore, it's quickly becoming a core operating necessity.
Now, speaking of those big picture risks, let's zoom in on the Middle East. The conflict there has really evolved into something more, a complex, psychological contest with global ripple effects.
And what's so fascinating is the dual-track strategy at play. On one side, you have these signals of negotiation with an envoy team that includes J.D. Vance. But on the other side, you have the hard power backstop, the deployment of the 82nd Airborne. It's a very clear message. Diplomacy is on the table, but so is military force.
So what's the real takeaway here? Well, it seems this impasse, this standoff, is really just buying time for asset prices to adjust. But make no mistake, this geopolitical risk isn't just a flash in the pan, it's going to be a sustained drag on global risk appetite for the foreseeable future.
Okay, all this uncertainty and the push for efficiency we talked about, it's pouring fuel on the fire of the AI infrastructure race. And Microsoft just made an incredibly aggressive move that validates just how intense the demand really is. Let's just break down the scale of this. They leased a 700-megawatt data center project in Texas. And in just the last quarter, they signed 50 times $1 billion of lease commitments. This is a huge strategic shift. They're moving away from building everything themselves and are leasing instead, which means they can get their AI services up and running and making money much, much faster.
So if you've heard anyone arguing that AI demand is slowing down, well, this move from Microsoft pretty much shuts that down. It shows that there is an extreme scarcity of premium compute capacity, and the biggest players are scrambling to lock it down.
Now, while Microsoft is securing all that digital infrastructure, the physical bottleneck in this whole AI race, that still comes down to one company, TSMC. And their guidance is just incredible. They've raised their compound annual growth rate guide to the upper 50% range. They've confirmed price increases of 6 to 10% for 2026, and their gross margin profile is pushing toward a staggering 60 to 70%. But, and this is a big but, there's a major energy vulnerability. Taiwan's power grid is heavily dependent on LNG from Qatar.
So what does this all tell us? TSMC's target of over 50% growth is a massive, high-conviction bet that this AI expansion is going to continue full steam ahead. But the key risk, the main variable to watch on the downside, is the resilience of that energy supply chain.
All right, let's shift gears from the cutting edge of tech to a deep dive on gold. It's often seen as a traditional safe haven, but it looks like we might be at an inflection point for real rates, setting up a potential rebound in the medium term.
This scenario analysis lays it out pretty clearly. In a Goldilocks scenario, the Fed has room to cut rates, which would be a positive for gold. In a hard landing scenario, the Fed would have to respond more aggressively, which would be very positive for gold. And even in a severe stagflation scenario, where the Fed can't really respond, gold still holds up as an inflation hedge.
So the bottom line here is that gold's recent weakness seems to be more technical than fundamental. The setup for taking a medium-term long position could actually become a lot more attractive in about 4 to 6 weeks.
And to wrap things up, let's come full circle back to technology. Because right now, we're seeing a close quarters battle for dominance in both AI hardware and the applications that run on it.
Here's a quick rundown of the key headlines. Amazon's AWS is developing an AI agent to automate sales and tech roles. ARM is creating an in-house AGI CPU, and they're targeting $15 billion in sales. Amazon is also making moves in robotics, acquiring FA Robotics to challenge Tesla's Optimus. OpenAI is pivoting from its Sora video model to world simulation research. And finally, Apple is rebooting Siri with on-device AI at their Worldwide Developers Conference.
So with all this happening, it really leaves us with a final massive question. We're seeing AI move beyond just a chat window, right? It's moving into physical embodiment with robotics and into creating entire simulated worlds. So is the demand for the compute power that drives all of this, is it shifting from just growing linearly to growing exponentially? That's the real question to think about.